what we'll go through today is I want to unpack the buying an existing home versus house and land. And I think in most people's cases, buying an existing property is more straightforward to understand. They can see it, touch it, feel it, etc. So I'll probably spend a lot of the time on buying house and land and what to look out for there, more so than the existing. But we'll go through the pros and cons, which mean that it's the opposite for the other, if that makes sense. So, well, I first want to talk about 3 ways to gain equity in your portfolio. So when we look at, and this is in our coaching booklet and in our academy, but when we look at the 3 ways, we want to ensure that we're getting more than just the one. Because I think traditionally most investors pin their hopes on capital growth, which is fantastic, and it's very understandable that they do that because it's the one that creates the most wealth in someone's portfolio. However, it's the least within our control out of the 3. So we look at number 1, buy at discount, number 2, add value, number 3, capital growth. Can we get all 3 when we go and buy? And more importantly, which asset is going to give us the best chance at all 3? Okay, so understanding that through your investing journey, your strategy will be different every time you go to the marketplace. The location might be different, the type might be different, the entity, the class of property, the yield, the cash you're putting in, the purchase price. Almost all of your strategy will change. So it's reading the market at any one time and understanding your long-term goals. Number 1, buying a discount. When we look at a property cycle, we know that the best time to buy at a discount or to be able to get a discount, whether that be 5 or 10%, or even 1%, is definitely when the market's flat or at its flattest, or in some sort of even downturn. Okay, so if you're picturing the property clock, you would say, well, 12 o'clock is boom. From there we start to readjust. So if we get a discount there at say 2 o'clock, yes, we've ticked the box of getting a discount, but how long until we maybe see some capital growth as a result of that flattening period in that particular cycle is the next question. So not pinning your hopes on just one is really the thinking there. Number 2, adding value. How can we add value? Either by adding value to the land by building on it or building multiple dwellings on it. Adding value to an existing house by performing a renovation on it, or extending or putting in a granny flat or something like that. So we're adding value to the yield, but we're also adding hopefully some equity into our portfolio that we can draw out to use with our next purchase or enhance our lifestyle. So which is least in our control? Definitely number 3, capital growth. If we were to say which one's most in our control, we'd probably have to say buying at discount, because we essentially know what the asking price is, but that doesn't mean it's the actual price. The price is what's the market doing in comparison with previous sales in that time period of the last 6 to 12 months, and then how much can we get as a discount below that purchase amount. Right, ensures that we can actually have discounting in our control. Adding value, yes, it can add some growth and equity in our portfolio. However, we need to keep that in perspective with how much we spend on that adding value, where emotion can easily take over, and we can add all the bells and whistles to an existing reno, or we can add the bells and whistles to a build. So we can definitely overcapitalise potentially in there as well. Capital growth, whilst we can do our indicators as to what is in our control in terms of research and getting the data, historical growth, etc., we don't know what's happening with the future. We can get a pretty good idea around, well, the market's been flat for the last 4 or 5 years, so we know that some growth should occur at some stage, versus buying in where there's been high growth for the last 4 years. Will that continue? The chance of it continuing at that level probably are lower. So capital growth, whilst it's in our control with the research we do, it's also very much out of our control in terms of it actually playing out and looking back and saying, yeah, we did pretty well, or we would have liked to have done better, but this occurred, etc., etc. Right. One of those things that's, regardless of any asset that you buy that's out of your control, is government power. So government power or new government could change regulations which affects capital growth right across the country, no matter what asset you buy. And an example of something that like that out of your control totally is what's happened to the share market with COVID. No matter what share you bought, if you bought it in, say, February or January, it would have gone down in value since you bought it, with not knowing what was about to happen in the coming 3 or 4, 6 months. However, the whole view of long-term buy and hold for best results stays strong no matter which asset class you're buying. Righto, so let's dig a bit deeper into house and land versus existing. So let's look at, first of all, the positives of building versus just buying something that's existing there. Number one is definitely the lower stamp duty amount. So when you buy a parcel of land and then with the intent of building something on it, you're only paying stamp duty to that state government or that state revenue office on the land value, not the actual projected build price, right? So that may be up to a 50% savings depending on your build. Or the purchase price. So that is a savings amount up front that you don't need to come up with or forecast when you're actually building. Number two is maximum depreciation on the building, which basically means anything brand new is at its maximum in terms of depreciating against that asset that's essentially going down in value. So the building value, just like a car, goes down in value as it ages, and as a tax-paying Australian, you've got the ability to claim back that depreciation amount. So you're not actually forking out that cost of depreciation, but you're claiming it back, if that makes sense. Okay. So traditionally, the land is what goes up in value over time. And then the third one is the time for the asset to grow whilst building. So in 99% of the cases, you've locked in the price that you've paid for the land, and obviously the build cost as well. So it might take 6 to 9 months or sometimes longer, especially if it's something that's unregistered land. But you've locked in the price that you're paying for that. If there is some growth in the market, you've captured that growth without putting in the whole amount as you would with an existing. Number four is the low maintenance ongoing. And so something that's brand new, like a brand new car, shouldn't need too much detailing to it in terms of maintenance or fixing repairs, etc., for the short term and hopefully the longer term as well. Got a situation where I've had a house in Adelaide for it's just gone 11 years, and it's only now that I'm starting to do a few different bits and pieces to it. So the first 10 years pretty much maintenance free from that point of view, and with that comes your warranties, etc., that are well and truly still in play from a building point of view. And then the last one I come up with was that it's very attractive for tenants to want to live in something that's newer and not necessarily 20, 30, 50, 60 years of age in that respect. So it's attractive for them to live in a brand new home without actually having to own it. And hopefully they keep it that way and look after it as though it is their own. That's for sure. Okay. So that's the positives of the build. So let's look at the cons or the negatives of that and as to why someone might not do that. So number one is definitely the time to complete. Some people would rather just having something that they can quickly transact on and get on with their life. The time to complete, obviously having not built anything yet, might take 6 to 9 months and in some cases longer. The uncertainty of the building group is a common one, or a fear of that, knowing that everyone hears horror stories. So the uncertainty of who they're dealing with as the particular builder potentially pushes people away from the build concept because they don't know the financials of the building group and et cetera, et cetera. The third one is the unknown of developer interests. Now, this is probably more so, not so much house and land, but more so off the plan apartments, etc. But in the case of developer interests, what I was referring to there is if there is a land estate that's say 1,000 lots, which is quite common in especially larger cities or outlying areas of the city. We don't know once you've bought yours within that afterwards just who they're going to be selling to, right? So right at the end especially. So I've got some tips and tricks around that, but again, the unknown as to who, what they're interested in and what their outcome wants to be from a development company point of view is also a bit of an unknown. The holding costs throughout the build are a factor that people either take into account and push aside, or think they need to cover off on, so it puts them off that as well. Now, for those of you who have been in our system for a little bit, you'd understand that the positive of the stamp duty savings is put towards the holding cost of the build, so one negates the other in that sense. So there's not really, when you look at those two side by side, it's not really a positive or a negative on either of them. It's pretty similar in most cases, especially probably more so you're saving money on the stamp more so than the cost of your holdings throughout the build in these times, because your interest rates are sitting a lot lower than they were, say, 4 or 5 years ago. And probably the biggest one for a lot of people is the unknown or the drawn out build timeframes that ultimately mean that they're attending to the process that's longer than expected, but also that's interest on the loan that they maybe didn't factor in. Okay, so which really comes back to the choosing of the builder, and number two, the uncertainty of the building group that puts people off there. Okay. So that's the positives and the negatives of building. As I mentioned at the start, knowing what an existing property is, right? We can know it, we touch it, we feel it, we understand it. We go through an open home, or we deal with an agent, or we buy it at auction, etc. Whereas the build process is, there's a lot of misconceptions out there, but there's also some unknowns. So we need to uncover those, and that's the idea of today. So on that, in that space of buying something, if that was our strategy, we need to understand what to look out for, because the negatives of any situation or the fears of any situation all can be overcome or managed through knowledge and education, I believe. So the first one is it infill land or is it a greenfield development? Right now, first of all, let me explain the two. Infill land is where there might be 20 or 30 or 40 lots, or even 3 or 4 lots of land that have been subdivided and parcelled to be registered through council, to be able to sell off, to know that council have approved to build some sort of dwelling on them, right? That are usually, well, they are in an established suburb where there's general housing all around them. So it's an existing suburb, and there's just been a parcel of land that over time nothing's been done on, and it's been developed and subdivided. So parcel of land is available there as individuals to purchase. That's known as infill land within a suburb. Greenfield development is the bigger, larger land estates that you see as you drive through suburbia. Now, it's more common to see a greenfield development further out of town in the major city centres or larger regionals. So you might be, in the case of like Western Sydney for the moment, you could go 40 kilometres west and you'll see a 2,000 lot subdivision, which is essentially greenfield development, meaning that there'll be anywhere from 10 to 15, 20 stages of that land estate. Okay, so stage 1 is released, stage 2 is released, maybe not in that order, but there'll be stage releases throughout that series. Okay, so the pros and cons of both, well, there's definitely less variables in an infill land estate where you don't, there's a lot less variables occurring in terms of who's buying into it, how long it's all going to take to complete, and controlling more controllables within that. Greenfield development may go on for 6, 7, 8, 10 years in some instances where stage 1 starts, they sell out majority of that, then stage 2 is launched, and then continue that process right through. Right now, which one is best for an investor depends again on the strategy, the location that we're buying, the strategy, the yield that we're wanting, the purchase price that we're going in at, etc. Over time, personally, I would look more towards an infill land conservatively because, as I said, there's less variables in relation to that. But why someone would buy in a greenfield development is what usually happens is if there is 15 stage releases, that stage 1 might be, I don't know, $500 per square metre. By the time they get to stage 10 or 11 or 12, it might be $600 per square metre. So there's demand through the completion of the development where the land value is continually going up for the same size, which means there's some built-in equity potentially for those that have bought in the earlier stages of the development. Okay. What traditionally happens at the end of greenfield developments is they're much smaller lots than the initial ones. They're in less superior location within the estate, but you're still paying the same price for the parcel of land that's actually smaller. So the land per square metre is much more expensive in an inferior location, if that makes sense. But some people like that because they can already see that the estate is almost complete, so they can, again, touch it and feel it. Whereas buying in at stage 1 or 2 or 3 of the development, all you can see is dirt for the into the distance, and you've got to really foresee just how it's going to play out. But strategically knowing that there should be some add value there. We definitely want to be within a high owner-occupier area, regardless of where we're buying, regardless of whether it's buying existing or regardless of whether you're buying in greenfield or an infill. You need to be in a high owner-occupier estate or suburb. Now, how do we get those stats? Quite easy. The Australian Bureau of Statistics has that in their suburb reports around the country. From if it's a new infill land estate or a greenfield development, then the real estate agent, the developer, the council will all have data around what their projections are for that. Now, can those projections change over time? Absolutely. But I know one recently that that I've been looking at where there's been about a 90% owner-occupier rate of within that estate. Now, it's only an infill land estate, but we know that if that's the case, that's where you want to be. And why do you want to be there? Because the builders, the mums and dads that are living in there are usually going to spec their homes up higher than what you would as an investor, which means yours is almost the worst house in the best street, even though it's brand new. So we don't want to be the best house in the street, along with all low quality investment homes that everyone's gone cheap on, which will all be treated that way in 5 years' time. You wouldn't know existed once a new estate. So my tip there is, should say Greenfield. If in a Greenfield development, ensure you are in the early stages of the release. I don't want to be in stage 14 of a 15-stage development in most cases, right? Unless it's really distressed and we're getting the price that stage 1 or 2 would have paid for its square metre. So yeah, knowing that you're in the early stages is gives you the best chance of getting that add value equity rise through the completion of the stages. Build quality needs to be mid to high range, so definitely not low range. Needs to ensure that the quality is sustainable through the long term, but it's also not that high that you're paying too much for the build relative to the fact that it's going to be tenanted. You don't want a situation where you've put in all these high range products only to see the tenant not treat them the way you want them, the way you would treat them, essentially meaning you'd need to replace them. Okay, so there's a fine balance of going too high, but also definitely steer clear of too low. So you're probably leaning more towards the higher than you are the lower in that sense. Okay. And then the last thing to factor in is your yield versus build. If you do go too high, just make sure that your yield doesn't suffer too much as a result of that. So I'll give you an example. So if we had some infill land that we bought into and the land was say 200K and the build was 400K, you've got a total pack price of 600K. But the rent in that area for that type of product, that size of building structure, etc., was only $500 a week, right? So $500 a week versus your 600K build, you yield, what's that, around 4.3%, right? Versus spending 300 grand on the build, which is that mid to slightly higher range potentially, and your rent is still around the 480, 490 mark, so your yield's closer to 5%. So you've got to get that happy medium of yield versus build, but we don't want to skimp on build just simply to go for yield either. Okay. If anyone has any questions, just unmute yourself and sing out. Also, just drop them in the group chat box if you need to as well. Forgot to mention that at the start. So that's what I would be looking out for in any situation, no matter where it is around the country. You've got to be in a high owner-occupier area. Infield versus Greenfield, it's got its pros and cons of both. The build quality needs to be on the upper end, but not too high. And then make sure you're in early stages of any release as well. Even when you're talking infill and there's 5 stages, you'd still like to be in the first couple. All right. So in respect to that, understand your strategy. Know what you're going to be up for. That 8-point strategy that I keep harping on about, knowing every indicator of that 8 and not letting one solely and wholly dominate the other 7 within that strategy. So knowing what that is. So first of all, is it capital growth? Is it cash flow that you're after? Is it tax benefits? Is it a range of all three of them? Is it just solely and wholly focusing in on one? Right. If we didn't want tax benefits and we wanted some higher cash flow, then we might look more regional, older property, et cetera, et cetera. If we wanted something with tax benefits, then we need to understand the negative gearing concept, but the depreciation being higher is often cool there. Never, me personally, I don't want a situation, I've never had this situation as an investor where the after-tax cash flow is dropped into negative, right? I might be negative before tax, but after all my deductions and claiming interest and running costs, etc., my tax return means that I'm getting a positive amount or positive cash flow amount after tax. So worst case scenario, over the next 5 years or however long I hold it, the property hasn't cost me anything physically to hold, although I've been able to benefit in reducing my tax over time as well, which has been cool. So know your strategy or understand what the key indicators of it are. Knowing your net yield before purchasing is also really critical. So there's gross yield, which, as you all know, is your annual rent divided by your purchase price times by 100 to get yourself a percentage. But the net yield is very different. The net yield is, okay, I've taken into account my income that I'm getting from the rent. I've taken into account all my running expenses. I've also taken into account my tax rate and how much I can claim all those expenses back at. And I've also taken into account my depreciation. So what does that net yield look like for me on this particular purchase? And if I'm tossing up one of two strategies, right, what's the net yield on both of them? And you might be surprised as to what the differences are there as well. Okay, so as you can see, it's just not as simple as just going and buying any old property that's sitting on realestate.com. Do your homework, or at least engage someone who does it for you. So when I look back to the negatives or the cons of the house and land strategy, right, a lot of those can be overcome, right? So one of the negatives was, who the hell's the builder? Hopefully they finish it on time. Hopefully they don't go broke in the meantime. Hopefully they employ good trades, et cetera, et cetera. Understanding and doing your homework on that, or finding someone who has done their homework on that, can put that to bed. Does it foolproof it? No, it doesn't, but nothing's foolproof in life. But you can definitely dig down and deeper to get a comfortable look at, well, this person who I'm engaging, or this company who I'm engaging to build has been around, is reputable, what they've built's been solid, et cetera, et cetera. And then keep an open mind on all strategies. So the one that's getting a hammering at the moment as a strategy is off the plan apartments, and probably with good reason, given that there's been some building issues, especially in Sydney, in the past decade. So is it, we need to ask ourselves as a sophisticated investor, is it a strategy that works, and can it be a strategy that fits within our portfolio over time? Absolutely, yes. Is it a strategy that we would employ now? Well, personally, probably not, but not because the building structures issues have been going on, because you can do your homework and research a lot of that. Again, although not foolproof, you can do a lot of work into that instead of just looking at the glossy brochure. But fundamentally, in the major cities, there is still a bit of an oversupply, especially in Sydney. So it wouldn't be a strategy that I would be imploring right now, unless it was a strategy that was purely for discount. I've got some good capital growth performing properties in my portfolio. I want to go and buy something with the view of getting massive discounts, and I'm probably forecasting that for the next 4 or 5 or 6 years, I'm not going to see too much growth. Okay, is that a strategy that I'll employ right now with that asset class? Absolutely, I would. Right, but fundamentally, if I'm going in with a strategy of capital growth, that wouldn't be the asset class that I would be gunning for right now. Hopefully that makes sense. Okay, so Blake, 18 months ago, Stephen Bradbury's situation with oversupply of new apartments in Brisbane. Do you think this is still going to happen? Has it happened? These builds still going on? Yeah, so there's a couple of parts of that. Yeah, so first part of that, oversupply, a couple of things have happened in that time. Building approvals have definitely dropped, which has helped suck up a lot of the supply in Brisbane in particular. Do I think there's that? Look, when you look at the vacancy rates, they're still pretty good. Like you're talking 3%, which is 3 weeks a year of vacancy. So there's not a massive oversupply. Can I go in and get a discount? However, probably I can probably grab maybe 5% if I looked around hard enough. Is the market just going to absolutely crap itself and fall through the ground? No. The fundamentals are still there in Brisbane. There's enough momentum in Brisbane for that to hold itself, because the building approvals have dropped and people are still moving to Brisbane to want to live in those precincts, and those precincts are only becoming more attractive because state government's spending a 100 load of money in all of those key areas close to CBD and in CBD. There's still builds going on, but nothing like there was 3 years ago. If the builds are continued at the rate that they were 3 years ago, then yes, we'd have a bit of a bloodbath up there. But no, I think it's recovering okay. Probably still able to get a discount, however. Hope that makes sense. Just on the corona thing as well, we're talking about markets. One thing that's dropped off because of this has been international migration, because they're physically not allowed in the country to live here. However, interesting with interstate migration, that the state that hasn't suffered through interstate migration has been Queensland. So, and usually it happens this time of year because all the people in Melbourne think that it's too bloody cold to live there, so they move north, and usually southeast Queensland is the destination of choice. So interesting to note that that New South Wales interstate migration has dropped. International definitely dropped, but for Queensland, that's still population movements still going pretty well there. Question, how does depreciation claimed play out when you sell the property in the future? Maria, so yeah, so you've claimed the depreciation in the tax year that you had that property, Maria. When you say how does it play out, what do you mean when you sell it? Do you have to pay that back, do you mean, or I don't quite. Unmute yourself if you want. We can have a bit of a yarn. So when we sell a property, there's basically a cost base of the property. So if we spend X on the property, we've also got X amount of stamp duty we've spent on the property. We've spent legals on the property. We might have spent building and pest. We can, and then when we sell it, we have an agent's fee that we sell with. We can claim those running costs against the cost base of our property, versus year by year where we claim something in the year that we own it. Right now, a good example of that is when we do a renovation on a property, if it's within the first 12 months of owning it, we can only claim that the renovation back on when we sell the property, because it's within the first 12 months of owning the property. But if we do the renovation after a 12-month period of owning it, then we can claim it in the year that we spend that money. Okay. Yeah, do we pay tax on the gains made? Well, yes. So we do pay tax on the capital gain of the property. However, owning it longer than 12 months, we'd pay a 50%. We get a 50% exemption. So we'd only pay 50% capital gains on that. So to give you an example, if you bought a property for $500,000 and you sold it for $1 million after having it for 10 years, 500 of that profit, 500 is the profit. 50% of that 500 is capital gains tax free at the moment. So we're only taxed on the 250K. Now the 250K is taxed at our nominal tax rate. So if we're paying 32.5 cents in the dollar tax rate at the moment, we're taxed on that amount. But then if we continue to go up over the threshold, we're up into maybe 45 cents category. So a 250K gain puts us automatically into the 45, right? But as I mentioned before, we've got some add backs there that we can claim against that 500K gain, if that hopefully it makes sense. But yeah, good conversation to thrash out with your accountant. And the thing to keep an eye on there, or keep in perspective, is if we're paying tax, we've made a profit, right? If we're paying capital gains tax, we've made a profit on something, so that's been a good outcome, versus losing money, right? So yeah, that's the case at the moment. Blake says, are satellite cities classified as greenfield, such as Springfield in Melbourne? Are these in a case-by-case for investments or too much further stages in development? Yeah, good question, Blake. So I would classify a lot of those satellite cities, especially out there, Springfield and surrounds, as greenfield land estates for sure. So does that mean they're a no-go zone? Absolutely not. Again, the migration level and the numbers suggest that there's mountains of people moving there, businesses being set up, infrastructure, etc. So there's a lot of stuff happening there that builds a solid case. However, there's probably been 5 years of that going on as a minimum. So do we, and it'll all probably play out and be complete in maybe another 5, I don't know, I'm just pulling a couple of year variance there, but do we want to wait for another 3 years before we buy into somewhere like that? Maybe not, because it's a one-off urban sprawl, and once it's built, then the growth, or maybe a majority of that, has come through. So the last element of growth in a greenfield land estate or urban sprawl is actually when everything's up and about and it's built, and the public transport's running, and the lawns are, the open spaces active, the kids' playgrounds are there, the schools are built, everything's going on, right? You don't want to be buying in when all that's complete and it all looks lovely. It's an ideal time to buy because it looks beautiful, but trust me, it's the last time you'd want to buy because it's all done. Those that got in 5, 6, 7 years ago would be the ones that would see usually the most growth in that potential. But Blake, just on that Springfield, I know it reasonably well. There's definitely your good and your not so good land estates, and that comes back to the owner-occupier versus investor dominance within those estates, and who the developers are and builders, etc. So yeah, case by case. Tracy, hi to you. How long after renovation and release of a rental property can you sell without penalty? I don't quite get the question. How long after a renovation can you sell without penalty? Can you maybe unmute yourself, Tracy, and just, I'll just have a bit of a yarn there. You there? Nope.
Is that better?
Yeah, got you.
Right. Sorry, I didn't have the microphone on. Hi. Sorry I was late.
You're right.
I have rented out my own home to tenants for personal reasons, and it's now been rented for a couple of years, and I'm thinking of renovating it in order to make sure it's in good, really tip-top condition before I sell it.
Okay.
I don't know how long between the time when I renovate and release before I can sell it without obviously it being sort of an obvious renovation to sell.
Yeah, when you say penalty, like what penalty are you talking? Capital gains tax?
Yeah, yes.
Yeah. So if it's your own home, you've got a 6-year exemption. So if you move out of it and you do some renovations after you moved out, you can still claim it as your principal place of residence, because you're allowed to claim one property. However, if it was a rental property and you were receiving income through that time, then the capital gains through that time would also be apportioned to it. So it's a case by case there, Tracy. Ideally, like someone asked me yesterday about when's the best time to do a renovation on an investment property. And I think me personally, I wouldn't do a renovation as soon as I buy it, because I can't claim that until I sell the property. I'd wait my 12 months. But in saying, if I do the renovation, do I try and get some equity out to be able to go and do something again? That's the to and fro that you have to play. In respect to your penalty or your capital gains, it would really depend on, the general rule is you can't have your cake and eat it. So if you got no capital gains tax, because you've lived in it the whole life, then you're rewarded for that, right? But if you move out and rent it, all of a sudden it's income producing, so the game changes.
Okay, that makes sense. Thank you.
Yeah. If you did the renovation but didn't receive an income prior or after, then you may that may help you out. But yeah.
What if you renovate and then sell it straight away and not bother to release it? I mean, I moved out for a different reason entirely.
Yeah.
And the place is actually positively geared, which is not good. So I'm really waiting until such times the market picks up, and then I want to get rid of it. But I wanted to make sure it's in the best possible condition, and it's been tenanted for 2.5 years, and it's not in the perfect condition it was when I first moved.
Yeah. So it makes natural sense from an investor mindset to improve the thing, so that when you're selling it, you're maximising your return. If you've got the funds, or unless you want to use those funds for another asset. So yeah, I'd be chatting to your accountant before you went ahead and did it, so that you know the variables. Yeah.
Great, thank you.
Yeah, no worries. All right, cool. I think that was all I had there. Some really good questions there as well. As I say all the time, stay connected. Running a podcast, as you probably know, My Millennial Money, but also we do My Millennial Property as an offcut from that, or an offshoot. Solvair Connect on Facebook. If you're not on Facebook, Solvair YouTube, we with all our video content there. Email blasts as they come about. Obviously, our monthly webinars. You guys dictate the topics, so throw them at me. I just run the topics that you want. So sing out if you have a certain topic that you'd like to discuss in more detail. And obviously our one-on-ones at the moment, they are Zoom into the future as well. But yeah, they can be whenever at your request, based on what you want to learn, based on what action you want to take, etc., etc. So yeah, anything else before we finish up? No, all good. All right, well, apologies for the time change today. Just it all got too consuming for me and bumper to bumper. So hope that was okay. Blake says gentrification next time. Cool. I'll add that to the list, Blake. Good one. You mean gentrification or regentrification of a region or a suburb? Is that what you're referring to there? Yep. Yep. Okay, cool. No problems. All right. Well, yeah, Loso show. Yeah. plenty of bucks in yucks, they say. So yeah, maybe that can be the title for next session. Thanks for tuning in and enjoy the rest of your week. Thanks, guys.